Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. And if this is your first podcast, 2025, welcome to the new year. It's only really now that some people are getting back to the office as we near Australia Day, which is typically the starter pistol for business in Australia, unless you work in sort of more sort of retail or hospitality areas or tourism. You've probably been pretty busy over the summer break with everyone travelling out and about doing stuff. I hear that international locations are more attractive than what they have ever been. And after all the lockdowns of the COVID period and everyone's stuck Australia, everyone's international right now. I saw a piece the other day, and this is a show about real estate, that they reckon Niseko in Japan now is like a mini Australia. There's property markets there over the last 20 years has tripled, they reckon, villas and apartments for people sort of looking to enter the ski fields. And, only saw the other day that Qantas now flies directly into, I think it's Sapporo, where Niseko is located. So for the period over the break. So travel meets property and meets property investment. I think a lot of Australians are buying property out there. So maybe a trend we can cover on the Smart Property Investment Show for 2025, whether or not they make good investments and purchases. But I think you're looking at a pretty hefty buy-in price. Most investors I know, a lot of people who are new to investing start off in perhaps more affordable locations. And now I want that to be the big thrust of today's podcast, the Smart Property Investment Show. There's 5 locations you can invest for under $500,000. Where to invest in 2025? Sounds like a great headline. No doubt our social media and SEO people will be happy that it's been framed that way, because it's the sort of thing that gets headlines. I don't know where to do it, but I've called someone in the studio that actually knows, I think, where to invest in 2025. The 5 locations under $500,000. That's Kev Tran from the Kev Tran Group. He's the director there. Back in the studio, semi-regular guest on the Smart Property Investment Show. Kev, you good, mate?
Phil, I'm good, mate. Thanks for having me back on.
Yeah, are you going to go and buy an apartment in the Seiko so you can go skiing?
We'll see about that. After I listen to the podcast, I'll see what the data shows.
You should do. Maybe if there's anyone in the Seiko that really needs me to come out and record some podcasts there and wants to fund a fully paid trip out there, I know the ski season is still pretty good in February and March, so I'd happily jump on a plane and come and do some interviews to come and look at the Seiko property. And no doubt there is people out there. I'll be happy to make that commitment out of my time to come out there and have a look around. But at one end probably of the investing spectrum, I know a lot of people sort of invest in holiday homes and whatnot, but that's not what we're talking about here. We're talking about the 5 locations for under $500K. So the purpose of this chat, so these are your recommendations of what is good investable suburbs or locations for where you can invest under $500K on the basis of what? Capital growth and how quickly? How should we frame this?
Yeah, great question. So maybe we'll set the stage first, what these locations are about, why we've picked them, and who these markets would be for. Right, just to set a bit of context. So
Good.
All of these markets, they're going to have a few criteria. They all have balanced and diversified economies. So these aren't mining towns or any cities that have 1 or 2 industries like tourism. They're too volatile for us. Mm-hmm. So when I go through, I'm going to go through percentages of different industries and all that throughout the episode, and when I go through each location. But we're talking about employment, right? There's also the GDP factor, but they're employment percentages that we'll talk about.
Yep.
So who this is for, someone who's looking to start or scale their portfolio, and especially for those who have a max budget of $500K. Obviously, if you can stretch a bit further, 550, 600 or more, you're going to open yourself up to more locations across the country, in locations that have more, economic stability and all this stuff. But if you're capped at 500, you're not limited to an apartment in a capital city, where if you've been listening to the show, you may know that it may not be the best option. So diversified economies, we look at infrastructure as well, what's happening in that area, unemployment and all that stuff. And then the second part is the supply and demand equation when it comes to the property market, because we want to know, is there limited supply? Is there high demand? What kind of situation we're looking at? And I'll break it down even further. I'll give some like what we call market categories. Are they early markets? Are they current hotspots? just to help people get a bit of a gauge and anything to watch out for as well. So that's the kind of the main gist that we'll go off.
So this is how you've framed your approach to assessing them as investable locations. Now, the 5 locations that you've identified, and you've given a good sense for how you would assess them for the purpose of the outcome you want. What I want to drill down is, and what is the outcome? So you invest in these properties today in these locations for the purpose of capital growth. Is that is that capital growth, immediate capital growth, or is it being able to find assets where you can manufacture capital growth quickly, whether it's through on the market or whatever?
Yeah, so it's also for people who subscribe to the idea they want to buy houses. So I'll just clarify that.
Yep.
Houses, these are established houses. So we're not talking about new builds or anything like that. And also our core philosophy is balancing both capital growth and cash flow. Because we want capital growth to be able to leverage into the next property with equity and build our wealth. Because we don't just want to focus on positive cash flow, because what's an extra $20 going to do for our overall wealth? But at the same time, we can't neglect the cash flow aspect, because we can't hold on to the assets in a high interest rate environment. That's going to be an issue too. So we balance the both. Then you can leverage and grow the portfolio sustainably, which is what we believe. Now, I'll add further when we go into each location. Some are current hotspots where you can expect short-term growth the next 12 months. Right?
So this is where they're in their market maturity.
Market maturity cycle, whatever you want to call it. So there's pros and cons of that, which we'll dive into. And there are other markets that are a little bit earlier. So we can also chat about who it could be for, because you may not need to get short-term capital growth, because either you've got a portfolio already or you want to diversify into different markets because you've already bought in some of the ones that I mentioned or whatever. So
and this is this view or the sentiment around everyone's objectives are different. Look, most will invest in property. I'm generalised. Most will invest in property because they want to create wealth, right? That's the reason why they do it. But how you do it, when you do it, where you do it is going to be determinant on where you are on your property investment journey. You know, you can't compare your chapter 2 with someone's chapter 8, right? So there's a uniqueness of your own story which is going to influence how and where and when you invest in certain areas. So, you know, getting into a market earlier, if you're a more sort of seasoned investor and you've got maybe a larger portfolio, you can manage that without the expense of compromising your investment journey, whereas other people need to be maybe a little bit more discerning if it's a new investment, right? Because you're going to be looking to extrapolate immediacy capital growth. So that is where and how you need to be working with if you're doing it yourself, that's fine, or with a buyer's agent, being really clear on where you are at and what your outcomes, what your expectations are and why. And this is the strategy part of it, right? The strategy of what you're trying to achieve, and then you need to match your strategy with the tactical application of it, and that's the buying. And that's where a good buyer's agent, I would say, operates, Kev. So what you're saying then is that some of these locations are going to give short-term capital growth. Some of them are going to be longer plays where you're getting in the market earlier and you may need to wait longer for that. But your baseline position as a buyer's agent is go for capital growth, but not at the expense of cash flow. Yeah,
exactly. But both are important.
Yeah.
But then when you enter these particular markets, because all markets will move in cycles. They'll cool down. They'll have heated parts of their cycle. But when you enter, so we can quickly talk about that. If you enter a market that's a hotspot, right? It's very low supply, very strong demand. You're going to expect short-term growth. Right? These are markets we're seeing 10% plus capital growth on a yearly basis, which sounds great. It's like, why wouldn't I want to just target them?
Yeah.
Well, the reality is they're very competitive to buy. Supply is very tight. So it could take longer to buy in these markets, and you are losing every time you're waiting on a monthly basis. Also, most of these markets, especially that I'll talk about, you're not entering at the beginning of the cycle, their current cycle. You know, some, like I'll talk about in a second, have had 30% growth in the last 12 months, plenty of steam left ahead, but just so you know, you're not entering in the beginning, right? Some other markets that I will talk about, they're not super heated right now. But when you enter, it's going to be much easier to buy because it's more of a buyer's market. And then when it does pop off, the indicators are there, you're going to ride the full wave for the next round.
So you might get 100% of the growth rather than the 50% of the growth, but it's about time in the market to actually be there when it happens. And again, having maybe potentially a bit of strategic patience where you may enter a market slightly too early and you might not get any growth for a year, for example. And a lot of people will say, well, you should have deployed that money in this other location, and you would have got a quick injection of capital growth, but then that may patter out. Whereas if you're into a market early and you get the majority of the growth, that can always and potentially outweigh, the cyclical nature of getting into a market mid or towards the end of it. So it's very difficult to get right. People think I know where to invest. I don't know where to invest. I always speak to buyers agents and other sort of property economists and forecasters. That's how I work out what to do. But I would assume then, by the very nature of this cap of 500K, there's not a lot of houses you can buy in capital cities these days for under 500K. Maybe there's a couple in Adelaide, and maybe you can go and find them. There's still some in Perth. It's moved on a lot, but so I'm assuming then that the majority of the locations you're going to be talking about would be outside the capital, so call it regional Australia, not rural, but regional Australia. A lot of people have criticism saying you shouldn't be buying, inverted commas, cheaper properties in regional areas because they're not going to perform as well as blue chip properties. Do you have a view of that?
Yeah, so I think what people need to also look at as well is the sentiment around that. Historically speaking, if you look at a lot of regional/rural markets, because unfortunately, outside of capital cities, there isn't a lot of clear data sets that kind of distinguish what's a strong regional versus a smaller regional.
It gets all bundled up,
It all gets bundled up, and you can kind of look at like ABS data, statistical area 3 and all this, and kind of clump areas with populations of 30,000 and all this stuff. But the main thing I want to say here is, if you look at the long-term growth rates for houses in the country, for capital cities, because we've got data for that, pretty clear, over 25 years plus, you're sitting around 6-7%. Right, it kind of fluctuates depending on the data set you look at. We know that it's not linear. Now, for regional cities, what I found is, just like every other capital city, they're not all equal. Depending on the size, depending on how diversified the economy is, they will perform differently. So some of these markets that we'll talk about here, they're still growing. And historically in the past, when the economy hasn't been diversified and they've been reliant on one or two industries, the resources sector or whatever, they are more volatile, which is the main concern that people have, which is fair enough. But Perth's also had that concern in the past, right? But now most people aren't employed in mining anymore, and it is a quite balanced economy. But that's just something we'll look at. Now, as markets become more established and more mature, you've got really strong regional hubs. You talk to people in Sydney, they would consider Newcastle a very strong regional hub. But many years ago, it was a small regional town.
And Newcastle today is deemed to be metropolitan, right?
Yeah.
And Wollongong and I think Newcastle are both metropolitan locations.
Yeah.
So consistent with a big city. I think Newcastle might be bigger than Adelaide, maybe. I don't know.
Exactly. So markets will grow and they'll mature. But what we're saying here is we need to have diversity in different industries and not reliant on any one particular sector, because then it's too volatile.
Yeah, it's you see a lot of big debate around this, which is this frame of reference that blue chip properties means inner city locations. So someone could only be deemed blue chip if it's in a capital city and in a fancy part of a capital city. Whereas I imagine your argument would be, well, you can get blue chip properties. It depends what your definition of it. Blue chip properties in regional locations and larger regional locations. To give some reference. And I'm not saying these are the suburbs that you're going to suggest here, but your places like your Bendigos or your Ballarats or your Bathursts or your Oranges or locations like Lismore's, they're large cities outside of the capitals. No doubt there are blue chip, inverted commas, properties in those regions, right? In those locations.
Yeah, absolutely. There are regions, within them you've got suburbs, better or worse and all that stuff. So
yeah, I know there's some massive proponents for regional investment in Australia. I don't know the stats, but they come across my desk all the time where you can always argue any point. A lot of people would argue that regional markets outperform from a capital growth or even a yielding point of view, both together or separately, sometimes capital city locations. But you have stalwarts who say you should only ever invest in property in the capital cities. Don't know. You do both, no doubt.
Yeah, well, I mean, if we exactly. We'll look at everywhere.
We're talking about a budget here, aren't we?
Exactly. That's the main thing here. Yeah. So we have no bias towards location. I have no affinity towards any market. However, if you ask the first question, where should I invest? Second question I'll ask is, what's your budget?
Yeah.
And that's going to eliminate a lot of locations. So either you can do nothing or you can buy an apartment in a capital city if you prefer. But there are many podcasts on this show that have gone through that as well. So.
Yeah, and this the argument also is that saying, okay, buy blue chip property, okay, fine, but everything's got to be budget dependent. I don't know the exact stats, but I would imagine a lot of people who are new to investing don't have huge amounts of money to deploy to property investment unless, they've been, coming to some money or there's been an equity event. So, most investors are starting out probably in these sort of cheaper locations because that's where they have to start out because it's tough to actually invest in property. So where to invest in 2025, the 5 locations for under 500K. Let's get, I think we've sort of given a sense for the why. You're looking at these. Do you have a sort of baseline of I think a 4.5% yield? So they've got to be at least delivering that, right?
Yeah, exactly. So where these are not median prices as well. These are where you can find a good range of prices for 500 and below.
Yep.
So there will be, of course, suburbs that are below that and some that are higher. And like I said, if you can stretch a little bit further, you can open yourself up, but you will be able to find deals 500K or below and with a 4.5% minimum rental yield.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show, and with Kev Tran from the Kev Tran Group, chatting about the 5 locations to invest in 2025 for under 500K. And as we sort of mentioned in the intro there, some of these would be for the purpose of immediate capital growth. Some of them would be with a view towards entering a market earlier with a long-term plan for that growth. And again, how and when you do this is going to be determined by your specific circumstances and decision-making about what is the current size of your portfolio, how much money you have to invest, etc. So make sure you consider all those things. Let's get into the suburbs because this is what people love talking about suburbs, right? The first suburb you've given me here is Townsville. Yeah. Everyone's talking about Townsville at the moment. I know the federal member for Townsville pretty well, Phil Thompson. He loves talking about Townsville. And any chance he gets to fly the flag for Townsville and tell you all the reasons why it's a great place to live. He's a military guy, he's a veteran. It's obviously a military town, Townsville, but this makes your list. And by the way, we're doing 5 suburbs. This isn't, it's 5 locations. This isn't in any order, right?
No,
Townsville is just one of the 5.
No particular order. I thought it fitting to get Townsville out of the way, so to speak, because it is probably the most talked about region in the last 12 months. A market that I've been fortunate enough to be buying in for over 18 months when it was an earlier market. But maybe we'll talk a little bit more about why, because I don't see people talk about why so much, just that because it's heated, it's a hotspot, like Perth, you go there. So we'll run off a few things, talk about the economy, then we'll talk about infrastructure, supply and demand, kind of in that fashion with all of them, right? So just give people a bit of a snapshot with Townsville. So it's the 4th largest city in Queensland after you got Brizzy, Gold Coast, Sunshine Coast. Right? Everyone's heard of them. A lot of people actually haven't heard of Townsville that much. So it's a large regional city, population circa just under 200,000. So it's a large city comparable to a Geelong in Victoria or Newcastle in...
Is it that big, is it?
Yeah, in New South Wales. So Newcastle, obviously, it's a bit bigger. But in terms of like how I see it anyway... is part of the wider city or the state. Unofficially regarded as the capital of North Queensland, it's a really key location as well, based on where it is, both like in terms of its port for commodities. It's a strategic defence location and also a cruise port. So it's located in a very special area. Now, at the moment, it's one of the most heavily invested areas in all of Australia. There's $11 billion either currently in construction or in the pipeline. Good mixture of government and private investment. Talked about that port. There's a $1.6 billion port right now in construction that's already released parts of completion.
And is that to bring goods and products into northern Queensland?
Yeah, so importing, exporting commodities. Over 30 diverse commodities go through there. Strategic defence port, but also a cruise. So I think it was a Queen Elizabeth cruise. I'm not sure what the exact name. Yeah, it came in, I think, earlier this month. So
Queen Elizabeth went in there, did it?
Yeah. So it's really exciting. But yeah, there's a whole bunch of different projects across defence. We talked about that: transport, tourism, energy, education. So there's a lot of jobs happening there. Unemployment rate is very healthy too, 4.1%. And also, to give more context with unemployment, if you look at the trend with job ad trends, it's higher So it went up during COVID and it stayed high. So it's still higher than its 10-year average. So all these indicators should tell you that it's a very healthy economy that isn't reliant on one industry.
Well, one specific, and this is the criticism you mentioned beforehand of regional locations, that they can be heavily reliant on single industries. But I think you've sort of indicated there the diversity of that. One of the sort of stats, I'm just going to my map again here just to make sure I get this right. To put this into perspective, the distance, and this is sort of close, and I think Townsville's just south. It's south of Cairns, right? But to give some sense, you talk the capital of northern Queensland. The distance between Melbourne and Brisbane is about the same as the distance between Brisbane and sort of Cairns or Townsville, right? Like, it's a long way from it's the same distance away from Brisbane as what Melbourne is away from Brisbane.
Yeah.
You know, to give a sense for, like, you know, this is a, in many ways it's an isolated town, is that it's so far out of the capital, and you said it's the fourth largest sort of Queensland city after Brisbane Gold Coast, or the areas of Brisbane Gold Coast and Sunshine Coast. So, you know, as a standalone area, it's a long way from anywhere, and it needs to be self-reliant and self-sufficient, and hence the reason why it's probably got that economic diversity, because it needs to be supportive of that wider northern area of Queensland.
Yeah, on that point real quick as well, a lot of people don't know that Queensland is very different to the other states in Australia where, you know, most people live on the coast. Like 50% of Queenslanders don't live in Brisbane. They're spread across all the different cities.
Yeah, and it's a big old state, Queensland. Like, when you give a sense for that, you know, you've got the big regional centres of Cairns, Townsville, Mackay, Rockhampton. Then you got the Sunshine Coast, Brisbane, and the Gold Coast, right? Like, you know, everyone's down in that south. Everyone talks about the southeast corner of Queensland, but what you're talking about here is Townsville, which is northern Queensland. So you can still find good investable houses for under 500K in Townsville.
Yeah, I'll give a couple of real suburbs in a minute. I'll talk about the supply and demand maybe for the area. So as a region, of course, you can always dive into the suburbs, but as a region, to give you a bit of context, if you look at current supply, stock on market is super tight, 243 listings, which represents 0.32% of total listings.
Okay.
It's really tight. Anything under 1%, really not many properties at all. Inventory is at 0.81 months. So that means that if there were no more listings coming online, currently based on the demand, it would take less than a month for all properties to be sold. You know, so you can say the demand supply equation there. Building approvals, so that is a good indicator of future supply. Am I going to buy in an area and then, like, in 2 years' time there's a whole bunch of new properties? Is at 0.64%. So super low, not a concern at this stage. And then from demand point of view, days on market sitting at 27, down from 37 12 months ago. So it's downwards pressure with demand, even though it's had some significant growth, which we'll go into in a second. No signs of it slowing down, so to speak.
So they're interesting indicators, and I was sitting there trying to be cynic and say, well, there's a lot of investment activity in Townsville, therefore probably a lot of the time on market, all this stuff is being influenced by investor activity. What's the sort of the slice up of sort of renters versus owner occupiers? Is there a big demand for rental accommodation? Is that as nature of the transient sort of maybe workforce that goes through with military and stuff?
So to add on that as well, because sometimes I do hear the follow-on commentary about military, because you hear Townsville and defence kind of synonymously. If you go top 5 industries, top one is healthcare and social assistance, 17%. Second one is public administration and safety. Military or defence falls into that 12%.
Yeah.
12% of people are employed in that field. It's still, it's not like 80% or whatever, right?
Yeah.
So that's one aspect. And then talking about the demographics of owner versus renters, that's something that we look at as well. So all the markets, they're predominantly owner-occupier driven. So 70-30 split, 70% owner-occupier, 30% investors. Now, some pockets, some suburbs do have higher investor activity. So that's when you've got to do your due diligence and find out if this is a good suburb for you.
So can you work out whether it's owner-occupier investors in certain locations? How do you find that data?
So we subscribe to a lot of different software.
Yeah.
H-Tag is a really good one that we use. Okay, so shout out to the guys at H-Tag. And you can see, and they'll have a lot of the data online. So on, like, say, CoreLogic and stuff, it'll say if it's owner-occupier or tenanted. So a lot of different softwares they'll aggregate all the data. And
they strip it all out, put it all together, and give you some
make it nice and
meaningful
easy
stuff.
for you to see.
So who's HTAG? I've never heard of HTAG before. What, it's just property data, is it?
Yeah. Software, data guys. So if you're an individual investor, you can have a look.
Yep.
You can add in filters, and there's a lot of things you can do. They're one of the sources that we look at for location research and due diligence. But so information is only as good as how you interpret it and therefore make your decision making off it, right? Yeah, and this is your point. So some areas of Townsville have more of an alignment to property investors versus owner occupier. You want to try and find good owner occupier. So you look at the renter owner ratio. You also look at things like your vacancy rate. In areas that, really high vacancy rates, there's a lot of rental properties. Something to be concerned about as an investor. But no, to your question, they're predominantly owner occupier driven. So yes, there is high investor activity, or we were talking about it a lot, but most of the growth is driven by locals.
Like locals, it's the local economy which is sustaining all these different aspects of it. You spoke about healthcare, public administration, retail, education, training, construction. You get some tourism up there as well. So any specific suburbs in, like, people think like there is a city of Townsville, but then Townsville is a region as well, which has like you have Newcastle, there's a CBD bit, and then Newcastle being the wider geographic area. So what suburbs do you like specifically in that price point under 500K?
What I'll do, I'll go through the growth cycle right now, and something to note about it, and then I'll talk about the suburbs. It'll make more sense. So we've got earlier markets / second wind, which are markets where they've already had a good growth in the last few years, but now we're seeing another run. And then you've got hotspots. Like I said before, really low supply, really high demand.
Yep.
Townsville, definitely a hotspot. All right, many suburbs have seen about 30% growth in the last 12 months. So I know some people that are like, get out of there, it's too late, so to speak. But I definitely believe it's there for the long term. Because something that you should note as well is, even though it's had strong growth recently, during the COVID boom, it didn't actually boom as much as the rest of the country because it was coming off a bit of a slump for 5 years between 2014 to 2019. It was previously, like 10 years ago, pretty reliant on mining and not that diversified, right? So it was affected around then. Unemployment was also hovering around 7%.
Okay.
So it's much different now. So the growth that we're seeing is kind of also like a little bit of a recovery growth in a sense.
Yeah. So it's making up for where it didn't perform like other markets did during that period of time. So where would you say you're saying it's a hotspot right now, and it's gained a lot of attention, obviously, but how far through that cycle is it? Like you're saying it's not too late to invest in Townsville. Like when would it be too late to invest in Townsville? What indicators would you start seeing?
Well, we have a look at some indicators of you take into account, or what we're doing is we do take into account how long it's been having that growth for. So then you look at the last year, 3 years, 5 years, and 10-year growth and say, well, how's it performing? Is it had, we'll talk about long-term average growth rate, 6-7%. Has it had much more than that? And that's one thing that we kind of look out for. Second thing would be in terms of those market indicators, how long is it taking for properties to sell? Is it taking a bit longer? Are they slowing down the demand? Supply, is there more supply coming on board? When we start seeing some pressure being relieved from the supply and demand aspect, then you can kind of make a call that potentially.
Okay.
There are other markets.
So it's still in a growth cycle, and you're saying that there's still legs in it. There's still some course to run. But imagine different suburbs are probably performing differently inside of Townsville. So do you have a recommendation on a suburb?
Yeah, absolutely. I'll give you a couple now. So there's Condon, typical price $478K, yields 4.94%. And then you've also got Heatley, $499K, and then yield is 4.82%.
And what do you find in there? Sort of 3-bed, 2-bath, brick type stuff? Is that pretty much what you're looking for? Just real basic, not, probably what, like 1980s built type properties, are they? Or 1990s built?
Yeah, some of them. And some of them you also get 2000s plus as well, but you are looking like a 3-bedder type for this range.
And how different are the other properties up there? Like if you could find like largely 3-bed, 2-bathroom, pretty well built, not need a lot of maintenance, does it really differ that much, like street on street, or is it really sort of suburb at suburb level?
Well, sorry, can you ask that again?
So like, how most of the I've never been to Townsville, and I've never been to Condon or Heatley. So do most of the houses look the same?
Yeah.
Like, does it really matter whether it's 27 Smith Street or 80 Smith Street or 80 Mississippi Street next door? Does it really? If you find the right sort of house in those locations at a suburb level, that's sufficient enough. It doesn't matter if it's on a different street.
Yeah. So, how do you know if it's a good deal, basically, or a good property if you're buying in the region? So for us, we go off some of the due diligence parts that we look at, probably out of the scope for this podcast, but a few things we want to make sure is, so we're looking at houses, minimum 3-bedroom, and there's a few other things that we want to look for. So key things would be avoiding busy roads, noise concerns, kids or families tend to stay away from them. Flood zones are really important. So there's a few things we can note about Townsville in particular because it is weather event prone. Bushfire risk, public housing thresholds. There's a few things that you go, oh, cool, is this a good pocket or is this property situated in a good location or not? Shape of the block, basically. If there's anything else as well, like say you go 3-bed, 1-bath, okay for this patch. What I would do is I would have a look to see if there's a whole bunch of comparables. If every single property in that patch is like a 4-bed, 2-bath and yours is a 3x1, yeah, it's cheaper, but it's going to be hard to find comparables to do refinancing. And it's just an inferior property, so just be conscious of that. You want to see a whole bunch of other comparables and you see that there's demand for that. Like it's trading and, for example, your 3x1 days on market isn't going to be like 60 when everyone else is 12. It's like, well, they're the things that we look for.
So it does matter.
Yeah, yeah, but like there isn't like a one rule, I should say.
Yeah. And land tax thresholds up there, it's different if it's in a trust or a company. Is that how it works up there?
Yeah, so a couple of things, I guess, for who this is for, things to watch out for. Council rates, insurance much higher in this part of the country versus, say, somewhere like Victoria. It is weather prone we talked about. So your due diligence and insurance are going to be very important. And land tax as well, if you're buying in a personal, like again, not, tax advice or anything like that, but 600K for personal or individual, and then under trust or company, 350K. So if you're buying under trust or a company, there is that threshold, and you can buy these homes where the land value is going to be less than 350.
Yeah. A quick question in New South Wales: do you get a threshold on land tax in a company, not a trust, but in a company?
I'm not too familiar. I understand that there isn't, not in a trust or not in a discretionary trust, which is why people go unit trust. Yeah, because you get the individual threshold there, but I'm not too sure about the company.
Yeah, it's just. It's hard to always find the right things anyway. You've got to count with this stuff. But you've got to consider these things when you're making a decision. Okay, so that's Townsville. And I've sort of been threatening to go up to Townsville and go and have a look. I might try and do that this year.
They got a nice casino there.
What's that?
They got a nice casino there.
Yeah, do that. I don't know. I was chatting again to the federal member for Townsville, Philip Thompson. And he's like, "You got to come and have a look at the place." Like, there's this. I think there's been an argument for me to justify heading up to Townsville. Like, there is an argument for me to go to the Seco as well to check out ski things.
Very important.
Very, very important. I'll do that this year. I'll get up there. I've got to get out a little bit more to the regions and have a look. And your next location, I've never been to. I mentioned it at the sort of front in this podcast as a location in Victoria, Bendigo, which most people would be familiar with Bendigo. When I think of regional. Victoria, I would think of Bendigo or a Ballarat or something, or a Geelong, right? So it's pretty well known, investable location. Tell us about Bendigo. Why do you like it?
Yeah, of course. So main thing here is it is a very well established, strong market. It's like a regional hub, considered Victoria's big three. So you mentioned before, the third largest city after Melbourne and Geelong. Population circa 121,000. Economy, again, is diverse. Healthcare, education, accommodation, food services, retail, trade, construction, people employed in a whole range. So there's no one dominant market. Unemployment rate is low as well, 3.7%, lower than the national averages. And again, job ad trends higher than the past 10-year average. So all things pointing to a very healthy economy. It was a hotspot. So I won't count the COVID boom because most markets boomed around then, but Ballarat, Bendigo, they had a boom and they were growing pretty well around 2018, pre-COVID, when Sydney and Melbourne were having a downturn. So it had its growth then, it had growth during the COVID boom, and then for the last 3 years, if you consider like 2022 is when the COVID boom ended, the last 3 years has been hasn't been really doing much. It's been pretty flat. But at the same time, rents have grown significantly.
Yeah, and that's probably consistent with where you've seen rent growth elsewhere, and whether or not sort of more recent times with a bit of an exodus of property investors outside of Victoria because of taxation issues. What's sort of the current supply and demand situation like there?
Yeah, so supply super tight. Stock on market is 178 listings, represents 0.31%. Inventory 1.16 months, so very go pretty quick. New supply, building approvals at 1.02%.
That's 1% of what's in approval versus the total size of the real estate market.
Yeah, total dwellings in the region. So yeah, not a concern as well into the future. Not going to be a massive influx of properties. Hold period, something that we look at, say, because they are predominantly owner-occupier markets. Hold rates or hold periods are an indication of like people like living there or not, or people like selling up after 3 years, sort of thing. So 9.2 years at the moment, up from 7.4 10 years ago. So the trends are looking good. There's a long-term stable market.
And demand in that area, is there sort of demand from both owner-occupiers and investors?
Yeah, absolutely. So all these markets we talk about are predominantly owner-occupier, 70-30 split thereabouts as a region. And then once you get to the suburbs, there's going to be some markets that are higher and all that stuff. So that's when your due diligence comes in. But in terms of demand, days on market for the region, so how long properties take to sell, it does vary quite a bit. So you've got some suburbs like California Gully, 27 days to sell, and then you've got White Hills where it's 81. So there's a variance. But the trends, if you look at all the markets over the last 12 months, has been pretty flat. So there isn't like you see a spike where things are taking longer or they're getting more high demand. Which indicates to me, you've got low supply and the demand is pretty stable. It's a pretty good market to enter if you want to negotiate and beat the crowd, so to speak.
Yeah, and we spoke about sort of growth cycle beforehand. Where is Bendigo in this year? You sort of mentioned its performance through COVID, but is it relatively new to a growth cycle, or is this one of these sort of locations which is a steady performer and it's largely going to deliver over the long term?
I guess I consider all markets that have strong economies going to be solid performers long term. But where it's sitting in its current growth cycle, I consider the second wind. So had a boom previously during COVID and before that, but the last 3 years, like we said, have been pretty flat with growth, capital growth. That's led the rentals to catch up.
Okay.
So capital growth last 3 years.
So that's that rental growth recently has just caught up.
Yeah. Which makes it more attractive for investors because now your yields are better, right? Which we can go through some suburbs in a second. But like 3 years capital growth 3%, so nothing happening, but rents have gone up 20%.
Okay, that's good going. So again, these things sort of sometimes move in not in parallel with each other, rents and capital growth, and there's lots of science around that. So what suburbs do you like there specifically?
So there's a couple. Let's go with this one first, which is California Gully. We mentioned it a little bit. 458K typical price and 5% rental yield.
5% is pretty high.
Yeah. Because of that. Because the rents have grown significantly. So now it's becoming more attractive for investors, but also if you're renting there and landlord keeps raising the rent, at some stage you go, mate, it's only 450K to buy a house. I might just buy this house. Yeah. When they put it online.
Okay. Anywhere else you like?
I've got another one that looks pretty solid. There's a few around this mark. Under 500, you've also got Eagle Hawk there as well. And if you can stretch your budget a bit further, there's a few other suburbs that look pretty good, like Golden Square as well. That's
sort of just outside of probably your 500K. But
yeah.
You can, so there is a fair bit of buying in and around those sort of those prices. What's the median price for? Just give me some perspective. What's the median price for like for that location? Is it around that sort of 500 grand, or is that sort of on the high side or low side? And you can get cheaper.
Yeah, it can get cheaper. There's a suburb there, Elmore. It's like 376K. And there's some ones that are higher priced too. So you do get a fair few that are like 550 plus, 600 plus. Yeah. But
All right. What would be the most expensive probably you could buy in Bendigo, like millions and millions. Like it's a pretty fancy place down there. Again, I've never been to Bendigo.
I don't know. I haven't looked because you know, like, as soon as you get past,
you're not buying that stuff, right?
Yeah, as soon as you get past 700-800K, the yields don't look very good. So
yeah.
you know.
Yeah. So it's better yielding at the lower ends because there's a lot more appetite for those type of properties, no doubt. Okay. So another location then in Victoria you've recommended here is Mildura, where they make orange juice, right?
Yeah.
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 Is that a big part of the local economy, is it?
Yeah.
Yeah. So you like Mildura?
Yeah. We like it. So Mildura, it's part of Victoria's far northwest. It's a bit of a smaller location, population 57,000. It's a scenic hub. It's situated kind of like close to New South Wales and South Australia. So with Mildura, it has a very low price, which we'll talk about in a second. But being a smaller market, that's something that we need to be conscious of, kind of front of mind. But there's a lot of stuff going for it. It's part of what it's called the Murray River Renewable Energy Zone. So currently it's enjoying a wave of investment. It also helps with job creation as well. Like many regional cities across the country, they're seeing investments in renewable energy like solar. Mildura is a big part of that. And also talking about orange juice, part of the strong agricultural background as well in manufacturing industry. So again,
right on the Murray. So the Murray River is really much the lifeline of that place. Is built up and grown around it, and agriculture being one of the. I always think about Mildura with the orange juice. So again, it's a diversified economy. What sort of job growth like there? Is it pretty strong?
Yeah. So job growth is strong as well. Unemployment is 5.2%, so it's healthy. And you're also getting transportation upgrades. So there is a good amount of infrastructure happening in the area. And with job ads, you're seeing they're continuing to grow over the last 3 years. So.
Yeah, it's a long way from anywhere, Mildura. To get to Melbourne? That's got it's probably 8-9 hour trip, is it? Sort of driving. It's So no doubt people who are in Mildura are there for the purpose of they're born and bred or for the purpose of work. So investable location is from a supply and demand type of situation. Is there people wanting a rental accommodation out there? Yeah,
so Mildura is a lot of Victoria has been pretty weak growth as we know for the last few years with a lot of changes to land tax and all this stuff. But Mildura has been a solid performer. It's just been kind of cruising along some solid growth pre-COVID till now. Supply and demand, a big part of that is because of really low supply. You've got 0.34% of available stock on market, which is just 91 properties. Inventory just over a month. Building approvals less than 1%. So again, no concern for long-term supply. And hold periods are also up. So 8.38 years, up from 7.4 10 years ago. It's looking solid.
And again, sort of growth cycle wise, is it sort of consistent with what's happening in Bendigo? Is it, again, these strong local economies typically have sort of, more of a stable growth curve to it? Is it where is it in its growth cycle? So
this one's also a second wind. Prices have doubled in the last 10 years, so 100% growth. Saw a boom during COVID and also some steady growth leading up to it. However, the last 3 years, it's just been solid growth. So it's up 18%.
It's strong. And that's just driven through supply and demand equation, really, is it?
Supply and demand, there's very low supply and there's demand for properties there. There's future investment there as well. So there's confidence in the region. But because rents have continued to grow more than how capital growth has been going, rents have gone up about 30% in the last 3 years. Your yields have continued to be strong. So it is a market where you're getting 5% rental yield, and the main it's a smaller location. The main suburb is going to be the suburb of Mildura.
Yeah.
Typical price $460K. So.
Yeah, I'm just looking at Mildura on a map right now. So there's obviously suburbs like Redcliffs and was it Merbin and places like that, but it's largely Lake Betsnook. Have you been out to Mildura? No. Welcome back, Phil Tarrant, having a chat with Kev Tran from the Kev Tran Group, talking about the 5 locations to invest in 2025 for under 500K, lots of fives. But the question before the break was, have you actually been out to Mildura? there's so many different suburbs to assess and consider. How do you work out even where to start? It must start with spreadsheets where you start just synthesizing data and looking for clues, and then sort of digging down at actual sort of functional level. Is that the way it's done? Like, you've got to start somewhere.
Yeah, so kind of macro into the micro. So macro, I'm looking at what's happening with the wider economy, looking at states, and then core philosophy that we have is we don't go regional versus capital city or whatever. We look at regions within cities, because even like Sydney will have local government areas, regions within Sydney. So we look at them as individual regions, and then from there you can then map out. Okay, cool. Well, there's these pockets or these regions within whatever state, population 60,000, 120,000, whatever, and then we kind of track. Kind of go. The next part will be, how's the economy? They're diversified. Is there a lot of infrastructure happening? What's the unemployment rate? If these markets aren't stable and have healthy economies, we don't look at them.
Yeah, it's about dismissing rather than trying to. A lot of people sort of trying to, look at investing locations to go, I really like this place, and then they'll go and try and prove the reason why they should be investing there, rather than the other way, is we're filtering out stuff till you get to a core amount that you can actually assess. And one of the sort of 5 suburbs that you're suggesting with 2025 is in Gladstone. Which is sort of, we spoke about Townsville, which is northern Queensland. Gladstone's sort of central Queensland?
Yeah, central Queensland. So back to Queensland for this one. So it's the second Queensland market. Might just quickly talk about the Victorian ones. I know I'm rambling on a lot, but this is important to note. So with Victoria, so there's Mildura, there's Bendigo. A lot of people have been talking about, there's land tax, even Melbourne, right? Just want to quickly talk about that, is because whilst no one likes land tax, right? No one likes any taxes, right? I hold property in Ballarat. We've talked about this before. Something we need to note is council rates and insurance much cheaper in Victoria as a whole than other parts like Queensland, right? People love Townsville. I personally bought in Townsville as well. However, your council rates and insurance is so expensive there.
Like, what would a quarterly council rate in Townsville be?
Annually is like what do we get? Actually, I haven't got mine yet, but I think when we look at it, it's probably going to be like $3,000.
Okay.
Yeah. Circa thereabouts, or 3.5, a bit more. Your insurance, $3,000.
Yeah, okay.
Yeah. No land tax, which is great, but it's a lot.
Yeah.
Comparatively, at half that.
So you can look at the whole budget rather than just looking at them in isolation. So people go, I'm not investing in Victoria anymore because of land tax. Well, when you do your maths, it could be consistent with what would the aggregate cost be if you invest in Queensland.
Yeah, it's net perspective is much better. But yeah, we'll go to Gladstone for this next one.
Gladstone's sort of a mining town, I guess you could call that, is it? Or is it a bit more diversified than that?
It's diversified now.
Yeah.
It was similar to Townsville, other markets that were very dependent on resources and mining back in 2014 to 2019. It also saw a bit of a slump, a reduction in price, but now, 2025, very diversified market. Has also, like Townsville, one of the most investment in infrastructure in the country as well.
Yeah, so obviously Gladstone Harbour is a big port in Gladstone by memory. I think the pipelines and stuff end up there. Yeah. What are you seeing in terms of diversification in the economy there? Is it shifting and changing rapidly? I know there's manufacturing being sort of attracted up those areas now.
Yeah, absolutely. So the manufacturing 15%, construction 12%, healthcare and social assistance 10%, retail trade 10%, and then education and training 9%. So they're the top 5 industries. Again, you can look at it and you go, okay, well, based on those numbers, it's quite diverse and balanced. And then in terms of infrastructure, what's happening into the future that's going to bring more jobs in and help the economy, livability. There's a current strong pipeline at the moment. One of the biggest ones being the Central Queensland Renewable Hydrogen Facility. That's it's currently in early planning, but that's like a $14 billion project.
Yeah, okay.
It's massive.
So, and supply and demand, no doubt, sort of consistent with what you're seeing in other Queensland markets with tight listings.
Yeah, definitely. So 132 listings at the moment on market, 0.45% of the market. Inventory less than a month, 0.98. New supply, building approval 0.52%. So not an issue with new supply now. Hold periods are also increasing over the 10-year period, with demand, median days on market for the region low at 42, staying that way as well. In terms of growth cycle, definitely a hotspot. So I'll say similarly to, I'll refer back to Townsville a lot. It's another market in regional Queensland that's had 30% growth the last 12 months.
Mm.
And then some people go, that's too much, stop going there. But again, 2014, 2019, there was a slump. Yeah, it saw a
So
boom.
by a slump, you just mean nothing really happened.
Yeah. So it actually saw a bit of a reduction as well.
Okay.
But yeah, basically, was not good for growth then. Main thing is going to be that lack of diversity in the economy.
Yeah, so it looks like that's recalibrated now to a more diverse economy. So 30% in 12 months, and a lot of people would argue, well, that's because there was no growth over that period of time from 14 to 19, and it by memory, it got a bit of a kick through the COVID period. So, would you be investing into Gladstone on the basis of assuming 30% growth in the next 12 months, or do you think that sort of significant growth has passed and it's going to be more measured growth moving forward?
Days on market still declining. Stock levels are very low still, and so the demand, I'm not seeing any change there, as in it's still very strong. So I anticipate there's going to be, if a hotspot, I consider over 10% capital growth. I would consider that for the next 12 months.
Okay, and any specific locations in Gladstone that you like?
Under 500K, one example would be West Gladstone, 482K and 4.9% yield.
West Gladstone, okay.
Yeah.
It's out near the airport, is it?
Something to note about Gladstone as well, a fair few pockets of it are going to be bushfire risk or affected. So
does it flood out there, Gladstone?
That's something
you've got to consider.
Yeah, you've got to consider as well, because all those things, safety, but also will affect your insurance. Not all insurers will cover parts of Queensland. So that's something you got to look at. Yeah,
and you got to do all that DD before you actually buy. Okay, that's good. Final location then, Western Australia.
Yeah, one for WA.
Yeah, Geraldton, on the coast. I think I've been at Geraldton. Tell us about Geraldton.
Coastal city.
Yep.
Midwest region of WA, about 424 k's north of Perth.
Right.
It's the largest city in WA, north of Perth, home to about 39,000 people. So again, another relatively smaller market, but self-sustaining.
Is it where you go to swim with whale sharks? Is that where you kick off from Geraldton and do all those sort of activities by memory? Tourism up there. Well, what drives the economy there?
We've got healthcare, social assistance, 15%, retail trade, 11%, education and training, 10%, construction, 9%, accommodation and food services, 7%.
So it's really a self-sustaining town, really, because you've got healthcare, hospitals and stuff, people buying stuff, schools educating people, people building stuff, and then food to live. So, it's a long way from anywhere, old Geraldton, but so you like it? Supply and demand, what's it look like?
Supply and demand, stock on market, 105 listings, which is 0.5%. Again, super tight. Inventory, 1.27 months. Trends are looking like they're declining as well in terms of how much inventory is coming up. New supply, building approvals, 0.44%.
Yep.
So again, no one's building at the moment there. Demand for the whole region, really low. Days on market at 25.
And sort of vacancy rates, is rent pressure pretty tight on it?
Yeah, super tight, 1.3% for the region. And of course, there are suburbs that are even sub 1%. Again, I'll go through all this. These are the affordable ones. 500K now is like the affordable. A few years ago, we were talking about 350, 400K.
Yeah, 500K is affordable.
Is a new affordable market. If you've got more, then there are stronger regions for you. But again, not our exhaustive list of markets that we're buying in.
Yeah, but I think you're sort of democratising property investment a little bit, where people think you need millions of dollars to get into it. You can actually still, to your point here, identify locations sub 500K, which are going to get you into the market and help you sort of creating capital growth without too much of a compromise on yields and stuff. So any area, where's it sit in its growth cycle? Is it late, early, mid?
It's a relatively early. It's a hot spot because it's the last 12 months we're seeing 30% growth as well.
Yep.
But I call it early because the last 10 years you had pretty weak growth.
Mm.
If you look at the total there, because previously it also was a lot of WA reliant on resources or mining. It also saw some pretty weak growth 2014, 2019. But since then, very strong.
So, question for you. So that's good. That's 5 locations of invest under 500K. What I would say is that a lot of people will be sitting there going, Geraldton's a long way from anywhere. It's a long way from where we are right now in Sydney. Yeah, like it's another world away. You got to get to Perth, and then you got to get from Perth to Geraldton, right? Like, if you're investing in regional locations, you've spoken about 1 in WA, 2 in Victoria, and 2 in Queensland. You haven't spoken about any regional locations in New South Wales. Can you actually find sub 500K houses in regional New South Wales? Yes, you can. You go out to Broken Hill and probably still buy stuff under 100K, right? But you haven't identified any locations there. So give me a sense, you're sitting in your home in suburban Sydney and you want to enter the property market. Like to go to Geraldton's probably maybe a step too far for people when they think the immediacy of regional markets. They could probably have at least more of a emotional connection with a Bendigo or whatever. How do you sort of shift that mindset to actually go, okay, I'll consider Geraldton. That's it sounds okay where it is right now for a purpose of property investment.
Yeah, you don't have to. I'll give one last thing. A suburb, for example, in Geraldton, Beresford, 473K typical price, 5%, 5.02% yield. So the best yield, or one of the high yields out of the list that we've talked about. So when we're talking about what market is best for you, there's a bunch of things. There's the cash flow aspect. There's where it's sitting in its growth cycle. What do you want out of it for the next 12 months? Also your comfort levels. If some people, because the reason why we talk about this as well is not to convince people to invest here. It's also to let people know the risks about these areas. Yeah. Because a fair few people come to me, they're like, I want to buy in this market, right? And they mention smaller markets to this that are mining risk or whatever. Yeah. And they go, I don't buy there. Yeah. They're like, well, can you? I want to buy there because it's affordable. I'm like, do you know the issues? There are people out there who will buy things without doing the due diligence. So hopefully, you can make an informed decision or at least know what to look out for. And I very much talk about this is I want that economic diversity. And if there are risks, at least you know what they are.
Yeah. And look, there's the risk in all investment, and property investment is it's a balance of risk and reward. If you've only got 500K to spend, you're going to be potentially looking at these sort of locations. Now, a lot of people would say, why don't you stop and wait and save for another 3 years until you get a bigger deposit and maybe change your ability around serviceability and buy in a more a capital city area or somewhere else they'll deem to be more blue chip. The argument with that is that in 3 years' time, the affordability price points change once again, and the measure of affordability for you, in many ways, for most people, they're going to be pegged to, how it dictates their buying. In that they're always going to be affordable locations, but the affordable locations is constantly changing, and often the speed of growth of affordable location often outpaces the speed of growth of people's ability to manufacture deposits and also, take on more debt, right? So to the point, when should you invest in property is when you could afford to invest in property. And if now is affording to invest in property because all that's really available to you is sub 500K properties in regional locations, well, that's the decision you need to make, and you need to accept that risk connected with it. That's the way it is.
Absolutely. And
good.
Hopefully you can get some insights from the Smart Property Investment Show to help you along the way.
No, it's good, Kev. Well, thanks for very being data driven there, and we could change this and say locations under $1 million. It'd be a very different conversation, right? We'd be talking about maybe outside of the regions and into the capital. So your price point and your ability to borrow and service that debt and ability to save a deposit, whether that's through realising some equity, having a principal place of residence and or saving your money will completely determine your budget. And your budget will determine where you're buying. So you're happy to buy at all price points, Kevin? Yes? Most?
Yeah, at least 450.
At least 450. It's hard to get good stuff under 450, isn't it? Yeah. And let's say just in closing, how much dough do you actually need in order to get into a 500K property? Let's talk brass tacks, dollars.
Yeah, so subject to the biggest cost you're going to have, obviously, outside of your deposit, it's going to be stamp duty. So it depends largely on which state you buy in.
Yep.
Queensland will have cheaper stamp duty than Victoria or South Australia, for example. But a good gauge would be like 80K minimum. If you've got 100, you're going to have some better options because you also want to factor in a safety buffer afterwards of X amount of your expenses, to make sure that you're not stressed after you buy. No money at all. You need those emergency funds.
Yeah, it's not the way to be. So access to capital is required because sometimes you get a leaky roof and you got to replace your roof. That's just completely unexpected, right? But what you're saying there is that, most you can if you're new to property investing, you might be happy investing with high LVRs, so borrowing at 90+%. Therefore, you've got LMI. LMI could be capitalised, lenders, mortgage insurance. So again, these are discussions you need to be having with your financier, your broker, and also your buyer's agent. But Kev, you're always happy to chat with people. They can just give you a call. Is that the way you work? How do people find you?
Yeah, absolutely. Easiest way, probably hop on the website, kevtran.com.au. So KEVTRAN.
We spoke about this last time because there's so many other Kevin Trans.
There's too many Kevin Trans.
There's only one Kev Tran.
One, mate. And then we're on all the socials, Kev Tran Group. And just have a look, check out some content, book in a time. Yeah. And we'll go from there.
All right. Thanks for coming in, mate. It's good to see you. That's Kev Tran Group, or just Kev Tran, kevtran.com.au. There you go. Track him down there and have a yarn. I'm sure he's always happy to, just if you want to pick his brains around, even if you want to stress test some of these user observations around investing in regional markets and get some more views on it, that's probably not a bad place to start. So get in touch. Thanks for tuning in, everyone. It's the Smart Property Investment Show, part of the Property Investment Podcast Network. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.